The current price for Rezolve AI PLC, trading under the ticker RZLV on the Nasdaq, is 4.61 USD as of the market close on Friday, January 16, 2026 at 4 p.m. EST. While the market is currently closed this Tuesday morning, the energy surrounding this stock has been anything but quiet over the long weekend. Investors are waking up to a reality that looks drastically different from the narrative that dominated the ticker just a few months ago. For a long time, the expectation was that this company was just another speculative name in a crowded field of automated commerce, perhaps overpromising on its ability to scale in a world where big tech already holds the keys. However, the reality hitting the tape is a 30% gain in a single week and a massive upward revision in revenue guidance that has left even the most optimistic analysts scrambling to update their models. The gap between what the market thought was possible and what the company just put on paper is currently the biggest driver of the volatility we are seeing. Just days ago, the company issued a guidance update that essentially shattered previous consensus. They are now forecasting approximately $350 million in revenue for the full year of 2026, which is nearly double what the street was looking for. To put that in perspective, the previous market expectation was hovering around $170 million. When a company tells you they are going to do twice as much business as the smartest people in the room predicted, you get the kind of explosive price action we saw on Tuesday and Wednesday. They also stated they expect to exit 2026 with an annual recurring revenue run rate of at least $500 million. This isn't just a small beat, it is a fundamental shift in the scale of the business. The market reaction was initially mixed because of the sheer magnitude of the growth required to hit those numbers, which briefly sent the stock down nearly 10% as skeptics questioned the visibility of that revenue. But as the week progressed, the narrative shifted from doubt to a fear of missing out. What really turned the tide were the research notes from Cantor Fitzgerald and H.C. Wainwright. These firms didn't just maintain their ratings, they doubled down. H.C. Wainwright raised their price target to $12, while Cantor Fitzgerald reiterated an $8 target. The logic here is simple. If the company actually meets these lofty goals, the current valuation is basically a rounding error. They highlighted a particularly strong December where revenue exceeded $17 million, marking the first profitable month for the company. This is a critical psychological milestone for any growth stock. Moving from a cash-burning machine to a business that can actually show a profit, even for a single month, changes the risk profile in the eyes of institutional buyers. It suggests that the operating leverage is finally kicking in and that the fixed costs of their platform are being covered by the rapid onboarding of new enterprise clients. The intraday movement on Friday was a fascinating tug-of-war. We saw the stock open at $4.77 and push as high as $4.97 before settling back down to that $4.61 level. This retreat from the highs suggests that there is still a significant block of sellers or profit takers who are wary of the 52-week high of $8.45. However, the volume was massive, with over 28 million shares changing hands, which is well above the 90-day average. This level of liquidity usually points to institutional rebalancing. When you see this much volume paired with a sustained price floor, it often indicates that larger players are building positions, absorbing the selling pressure from retail traders who might be happy with a quick 20% gain. We need to address the elephant in the room, which is the massive short interest that has been building up against this stock. According to recent data, the short interest as a percentage of the float is sitting at roughly 24.66%. That is a heavy weight for any stock to carry, and it explains why the price action is so violent. Short sellers are betting that the company will fail to execute on its massive growth targets, or that the dilution from previous capital raises will continue to devalue the shares. We have seen borrow rates for shorting this stock spike recently, moving from around 1.5% to nearly 9.5% in just a few days. When the cost to maintain a short position jumps like that, it puts immense pressure on those traders to cover their positions, especially when the stock is trending upward. We are also seeing a high volume of off-exchange short activity, with nearly 48% of the daily volume often coming from dark pools and non-exempt short sales. This is a classic battleground scenario. For the retail investors watching this, the signals to monitor next week are the days to cover and the option open interest. If the stock can break and hold above the $5 psychological resistance, those short sellers might be forced into a coordinated exit, which could trigger a significant squeeze. However, you have to be careful. Chasing a squeeze is a high-risk game, and the borrow cost spikes can be volatile. You should look for transparency in the institutional filings to see if the big names are actually sticking around or just playing the volatility. Comment below how many shares of this company you currently hold, or if you are sitting on the sidelines waiting for a better entry point. It is also worth looking at the fail-to-deliver data from late December, which showed hundreds of thousands of shares failing to settle. This usually happens when there is a lack of available shares to borrow, further tightening the noose on the bears. To understand why people are so divided on this, you have to look at what they actually do. The company operates a platform called the Brain Suite, which they describe as infrastructure for agentic commerce. In plain English, they provide AI tools that help retailers automate everything from customer search to the actual checkout process. They aren't just a chatbot company, they're trying to be the connective tissue between a consumer's intent and the final transaction. They have signed up some heavy hitters, including names like H&M, Urban Outfitters, and Ferrero. These aren't small pilot programs, these are enterprise-level deployments. Their model is largely subscription-based, which is why that annual recurring revenue figure is so important to the bulls. They have also partnered with Microsoft and Google to use their cloud infrastructure, which gives them a level of global reach that a company of this size wouldn't normally have. The skeptical take is that the retail industry is notoriously slow to adopt new technology, and that competition from established players like Shopify or even Amazon's enterprise services could squeeze their margins. The short thesis often rests on the idea that the company is burning through cash too quickly, and that the $120 million they have in the bank won't be enough to get them to sustained profitability without another round of dilution. But the company countered this by stating they expect to hit an adjusted EBITDA break-even point by the second quarter of 2026. If they hit that target, the short thesis essentially collapses because the need for external funding disappears. This creates a massive tension between the expectations of a total collapse and the reality of a company that might actually be finding its footing. Looking at the broader sector, we are seeing a lot of momentum in the software infrastructure space, especially for companies that can prove they're adding real value with AI rather than just using it as a marketing label. While peers like Palantir have seen massive runs, this stock is still trading at a significant discount to its 52-week highs, despite the improved fundamentals. This lag is exactly what the bulls are playing for. They see a company that has been de-risked by its recent partnerships and guidance, but is still priced like a speculative startup. The reality of the situation is that the next few months will be a proving ground. The earnings report expected in early March will be the next major catalyst. If they can show that the $17 million revenue month in December wasn't a fluke and the momentum carried into the first quarter of 2026, the stock could easily retest those $8 levels. The macroeconomic pressure shouldn't be ignored either. We're in an environment where interest rates are still a factor for growth stocks, and any sign of a slowdown in consumer spending could hurt their retail clients. However, the company argues that their tools actually help retailers save money by increasing efficiency and reducing cart abandonment, which makes them a defensive play in a downturn. This is a bold claim, and it is one the market is still debating. Do you think the analysts at Wainwright are right with their $12 target, or are they being too optimistic about the pace of AI adoption in the retail sector? The retail sentiment on platforms like X and Reddit is currently leaning towards a squeeze, but the smart money is looking for sustained revenue growth. In summary, we are looking at a stock that is currently the site of a major ideological war between the bulls and the bears. On one side, you have management and several major analysts projecting a tenfold increase in revenue and a path to profitability within months. On the other hand, you have a massive short interest betting on execution failure and dilution.
The week's 30% jump was a significant win for the bulls, but the retreat from the intraday high of $4.97 suggests that the bears aren't giving up without a fight. The reality of the first profitable month in December has given the company a credibility boost that it desperately needed. As we move into the end of January, the key will be watching those borrow rates and seeing if the stock can maintain its new support levels. The expectation was a slow, painful grind for this company, but the reality is a high-speed sprint towards a massive revenue goal that could change everything for its shareholders. The central insight here is that the market is finally being forced to price in the actual contracts and revenue visibility that the company has been talking about for a year. The disconnect between the previous consensus and the new $350 million guidance was too large for the market to ignore any longer. This stock is no longer just a story. It is becoming a numbers game. If the numbers hold up, the shorts will have to cover, and the upside could be substantial. If they